What is going on with Apple stock? Just this year, they are down 5%. Now, when we compare that to the likes of Amazon, other companies in the Magnificent Seven, they are up 12% year to date. We have Microsoft up 8%. We have Meta Platforms up a massive 37% and Nvidia up 47%. So why is Apple stock not doing as well as their competitors? Let's find out in today's episode. What we're going to do is we're also going to take a look at their results that they reported to understand where we can see the lack of growth from this company, and we'll also touch upon the Vision Pro, whether or not this is something that will take Apple's revenues to the next level. As always, we will run through their valuation. We'll look at the income statement to see how well their top line has been growing over the last few years. We'll look at the balance sheet as well. We want to see how safe is this company. Do they still have a lot of cash? Are they burning through it versus their total debt amount? We'll also compare them to the performance over the last year from other competitors as well as the industry. We'll look at the dividend safety. We'll dive into their financial metrics to see whether or not they have been increasing over the last few years. We'll touch upon some insider selling that we've seen, nearly $25 million worth, and we'll look to the institutions, whether or not they still are adding shares of this to their portfolio. And finally, we'll run them through the valuation model to get to our intrinsic value to find out our acceptable buy price given our investor margin of safety. And we'll also look towards Wall Street to see what they're forecasting for this stock over the next 12 months. We want to take a look at how well Apple have performed over the last 3 months. So this is their latest earnings, quarter 4 of 2023 versus quarter 4 of 2022. We want to draw your attention to 2 points: the net sales here by reportable segment as well as the net sales by category. So let's start off by the segment. Essentially, we want to draw your attention to the fact that their net sales has increased in every segment other than Greater China. So we see Americas has gone from 49.3 billion to 15.4. However, what we note here is Greater China has actually dropped dramatically from 23.9 billion to 20.8 billion. Otherwise, overall, they have increased their top line 119.6 billion to 117, although we do see this isn't a very, very fast growth that we have maybe come to expect from Apple. And we also want to point out in terms of the category of sales, now the iPhone has increased 69.7 billion to the previous quarter from last year at 66. But we know in terms of the Mac, it has remained fairly flat over the quarters. And we can see the massive drop in the iPad going from 9.4 billion to 7 billion. And we also note a drop in the wearables. So these are things such as the iWatch from 13.5 billion to 12 billion. So we are seeing here some slowdown as well as some negative growth in especially the Mac, the iPad and the wearables, and notably the reportable segment of China losing a lot of sales. So how can Apple start to reignite the flame? How can they start to increase their top line? Now, one of the ways, a lot of people, I'm sure you would have heard, they recently released the Apple Vision Pro. Now, this is very similar to what Meta have. I haven't personally used any of these products, but what we can see, their sales do appear to be higher than expected. However, what we have noted is it is a very, very hefty price right now at around $3,500. And a lot of users are saying the case for this is limited. Hence why we can see here that a lot of people are starting to return their products. Right now, though, they expect the sales to be around 160 to 200,000, which is quite a significant amount. Now, we can see here just a tweet where essentially from people who have used the products. Now, again, it is very expensive and a lot of people will be expecting to use this product for a long time. But when people do buy this and find that essentially there isn't a lot of use for them, they are returning it. So I think we need to wait and see for at least a few quarters before understanding the impact of the Vision Pro on Apple's top line. So let's get to the actual numbers. Now, September 2019, 5 years ago, we want to see 3 to 7% growth year on year. So Apple have grown their top line from 260 billion in 2019 to their latest annual report, 383 billion. So that is a massive increase over the last 5 years. What we want to point out, though, on a more granular level, they increased their top line from September 2019 to September 22, although we have noted a drop in their top line to 2023. So we'll look at the last 10 years percentage-wise, but we can see over the last year, full year report, their top line has reduced. there is a bit of worry with Apple, which we will discuss, about their growth slowing down. And that is why we did mention the Vision Pro. It is one of their latest products, to see how that reignites Apple to an increasing company on their top line. Bottom line then, 55 billion in September 2019. 97 billion in 2023. So again, similar to the top line, they have increased their bottom line in a very similar fashion. It has increased to 2022, although we do note a small drop into 2023. So it isn't a massive worry. They are making a huge net income, as well as their revenues are massive, but we want to understand whether or not this is the best investment to make versus the others in the Magnificent Seven, as well as other options we have to invest our money. So in terms of a quick health check, total cash versus total debt, 100 billion in 2019, a huge amount, but we do notice in their latest quarterly report this has dropped by around 30%. So yes, it is still huge at 73 billion, but we can see they have started to put that money to work. In terms of comparing that to their total debt numerically and directionally, we can see it is very significant at around 108 billion in 2019. It hasn't really moved over that 5-year period, so it is still around that level at 108. But now it is interesting to note that their total debt amount is higher than their total cash. Now, looking at how they've performed over the last year in this specific industry, we're comparing it to Dell Technologies, Supermicrocomputer, HP Inc., other technology, hardware, storage, and peripheral industry. We can see over the last year, this includes those dividends reinvested, which is very small for Apple. It is sitting at around 19%. Now, when we compare that over its competitors, we can see a lot of them. Dell have performed very, very well. SMCI, absolutely phenomenal. But there are some others like STX that have also outperformed Apple. Now, expanding that over the last 5 years, we can see that Apple is the second strongest at 348% versus SMCI at around 5,000. I mean, this is absolutely insane. But I think what is key here to remember, Apple has performed very well over the last 5 years. It doesn't necessarily mean that past performance is an indicator for future performance. Now, one thing we just forgot to mention is that it is around the 52-week high, mid to upper end. It has to have a yield of 0.52% and a forward PE sitting around 28. Now, what's quite key to discuss is any insider buying and selling. Insider buying, as always, we do see it as a bullish signal. Management buy for one reason, as the GOAT Peter Lynch said, because they believe the share price will go up. Insider selling, however, isn't necessarily a bearish signal. Management sell for many reasons, and that's whether that's personal reasons, financial reasons, but we still are transparent. We run it through the screener, and we can see the principal accounting as well as the senior vice president having sold many shares, and we can see around $25 million worth, although we do note this was around November, and we can see the share price, in fact, since then has gone down. Speaking of insider buying and selling, just to let you know, we have a free weekly newsletter. Now, the latest article ran through companies that insiders were buying a lot of shares, as well as companies where insiders were selling a lot. We have other articles discussing our 7 golden dividend metrics, how to identify undervalued companies, and we are releasing a fresh new article today. So click on the pinned comment below to be up and grab a free copy. In terms of institutional ownership, well, it sits at 58.5%. We see around 75 billion worth of sales by these institutions, a huge amount, but we see a lot more, nearly double at 134 billion. So we can see over the last 12 months, institutions have been buying more shares than selling. We know in Q1, Q2 and Q4 a lot more buying, although we can see in Q3 a lot more selling. So overall, institutions are buying more shares of Apple, and in fact, the latest quarter they are buying a significant amount. So maybe they do see this drop as an undervaluation signal for Apple. But remember, it is imperative to always do your own due diligence, never copy what the institutions are doing. So dividend safety score, it sits at 99, very safe. Market cap 2.84 trillion. We're talking about a mega cap company. Key recessionary metrics, well, they didn't pay a dividend during this period. They have above average growth, plus 14% versus the S&P's negative 12. And they also had a near recession return, negative 50 versus the S&P's negative 55. Dividend growth then 4.3% in May 2023, so it's around that inflationary increase we always target on the channel as a minimum, just to keep up in line with inflation at 4%. Bit disappointing though for a big company like Apple with a huge amount of cash and a low payout ratio. 7% on average over the last 5 years, 9% on average over the last 10 years, and when we take a look, they have been increasing that dividend for the last 11 years. So in terms of dividend yield theory, as always, it states a company is undervalued when the current yield sits above the 5-year average. So right now we have a signal of reasonable valuation / some small overvaluation, but it's important to note we don't look at any of these models in isolation. We will conclude towards the end. Forward P, 27.6 versus 26.2, so again, roughly in line there. And when we compare it to the information technology sector P, Apple doesn't sit too far off. So in terms of the free cash flow payout, remember earnings is susceptible to manipulation by management through accounting. My own personal preference, 60%. I want to see it below that. It gives me faith that management can offer those double-digit dividends we love to see. Very low for Apple. In fact, since 2020, it's been below 20%. 2024 expected 14%. So I would be disappointed if we don't see a strong double-digit increase to the dividend in 2024. Nice to note the free cash flow per share has been increasing more than 3 times over the last 10 years. 2024 expected to go even higher. So this is a nice company when looking at free cash flow. You do expect it to increase consistently year on year. Now this is what I was referring to earlier when looking at their sales growth. We can see in fact 3 of the last 10 years it has had negative growth. The more notable year, 2023, negative 3%. Now that is very disappointing, especially the last 3 years were very strong. Now what we're looking for here in 2024 is to see how well that Vision Pro has really affected Apple's top line. And we want to see Apple growing that top line double digits, but it will be interesting nonetheless. Numerically then, more than doubled their top line, 183 billion in 2014, 383 in 2023. They also do a lot of share buybacks, returning excess cash to investor pockets, reducing it from 24.5 billion to 15.7. So in terms of the ROIC, again, if you do pick up that free weekly newsletter, it is one of my 7 golden dividend metrics. I want to see personally 10% or more to give me faith that management are able to effectively allocate their capital. It's more than doubled, and it was already very strong in 2014, in 61% in 2023, absolutely phenomenal. And the margins, again, nothing really to know other than the fact that it's consistently above the minimums by quite some margin. 30% over the last 3 years, very strong, and 26% on the free cash flow margin side as well for Apple, absolutely insane. Now the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Remember what this signals is 1, that dividend safety, and 2, the balance sheet strength. So we can see even with that cash reduction and the total debt staying the same, 2023 of 0.44, so the number of years it would take them to pay off all of their debt net of cash on hand, is still very strong, well below the 3. 2024 expected to go even lower, so no worries with their balance sheet, no worries with that dividend safety. Let's jump into Apple stock valuation. As always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So the first model we're using is the multiples valuation model. Companies in a similar sector and size. We have their average P multiplied by the PE or EPS in fact of Apple to get an intrinsic value of $270. So we have our first sign of undervaluation, but do bear in mind we don't look at any of these models in isolation. Dividend discount model, then we can see the average growth 5.65%. Forward looking, we have gone higher. We are anticipating that they will start to increase those dividends at double digits. So we in fact believe this to be a little bit conservative. This gives an intrinsic value below the market value. So we have our first sign of overvaluation. We then look at the DCF model with the free cash flows year on year. Average growth rate at 12%, so we've actually gone lower than analyst targets as well as lower than the average. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we can see here another undervaluation signal. So the intrinsic value for today's episode is just the average of these 3 models, which for today's episode comes to $212. Now, margin of safety is something we use, and we use 10% as a base if we believe it meets 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that for Apple, well, an acceptable buy up to $190 at 15%, around $180. So it isn't too far off. We see around 10 to 15% as a margin of safety for Apple right now. If you wanted around 20%, it would be around $169. So right now, you get at least a 10% margin of safety. In terms of Wall Street and their forecast over the next 12 months, well, they see a price target of $208 with upside of 13%. As always, let me know your thoughts in the comments below, whether or not you do believe that the Vision Pro will have a massive success, hit that top line, and see them continue to grow after their reduction in 2023. And don't forget, you can grab a copy of the valuation model to get to the intrinsic value, as well as the acceptable buy price of companies in your own portfolio or on your watch list by clicking on that pinned comment below. As always, have a great day. I'll see you on the next one, and take care for now.